David Semmens is US economist at Standard Chartered Bank, joins me in the studio now. And so, David, you're saying that all in all, the big takeaway for you from the Fed's announcement is it's a little bit more encouraging, but don't get too carried away. Why?
Well, growth has been slightly better, and you are seeing an improvement in the labour market, but the labour market is unfortunately a lagging indicator, and it's reflecting a lot of the strength that we saw coming into the end of last year. Now, we're looking for a very weak start to 2012. We're looking for only 0.8 in the first quarter of this year. You're seeing consumer spending, actual PCE, which is what the Fed looks at, being particularly weak. So even though retail sales were encouraging yesterday, that's a nominal number, and in real terms they're actually not that strong, which unfortunately is not going to see the economy picking up particularly well.
What did you take away from the language on quantitative easing? What are the prospects for QE? Is it still an option that could be embarked upon this year, or were they dampening expectations?
Well, the fact they could mention it one way or the other means that it's still firmly on the table. They didn't give the green light to QE happening immediately, but we think it will come as early as the June meeting, simply because we're looking for growth to be particularly weak. And inflation expectations are very stable. And for the Fed, they see inflation being either on target or below target, which means that quantitative easing and further monetary accommodation is still firmly on the table.
But of course, inflation could become a problem, and that could have implications for monetary policy if there was to be an external shock to the US economy. I'm thinking about an oil price rise, a sudden one.
Well, they acknowledge that oil and gasoline have been picking up of late, but that seems a temporary problem. It would only be an issue for the Fed if we were to get consistent oil prices over the next 18 months, and it becomes more of a permanent trend that oil is edging higher, because obviously when you have a pickup, a shock at the beginning of a year, then in the second half that will reverse out, and then the following year you'll actually have the negative base effects, which will weigh on the headline. And it's really the core that they look at rather than the headline number that they get concerned about.
But when will we know if it is definitely a trend? Because really we're seeing a 10 to 15% rise in the price of oil already this year. I just spoke to an analyst not long ago who said that we could see it reach $150 a barrel. So if anything, the trend does seem to be, there seems to be a lot of upside risk there.
There is definitely upside risk, but at the moment, without there being further political issues, shall we say, we don't think that oil is going to go to 150, but if it was to go to 150, that would definitely hit the US consumer very hard. From our calculations, it would take off around 1.4 of growth this year, which would essentially see the US consumer add nothing. And that would obviously be catastrophic, for not just for the US, but for the world. But we don't see that as being a scenario. That's more of a doomsday scenario.
And David, what about the types of QE that the Fed could potentially adopt? We've been getting reports about the possibility of sterilized quantitative easing. Would that be a positive thing for the US dollar?
Yes, I mean, that would be taken far more positively, because it's going to essentially neutralize what happens. It would bring rates down without increasing the amount of dollars in circulation. And that would really be to appease the hawks on the Fed, because all the previous QE that's happened has been unsterilized, and that's raised concerns about future inflation. Whereas if this was to be sterilized, then that would actually get them on board far quicker.
What about the risks to the US recovery, not necessarily coming from an oil price shock, but the internal problems? I'm thinking specifically about the housing market. Do you see significant weaknesses there that could pose a problem, if not now, but say in the next few months? Well,
I think the housing market has certainly bottomed, but the main problem is it's not really providing any uplift to the economy. So it's really going to be the consumer that's got to do the heavy lifting, and also you've got to have businesses feeling more encouraged. And business investment, although it's positive, it's still not particularly strong, because you're at the end of the investment tax credit.
But we have had the Fed stress tests come through, and banks have fared very well. Most of the banks passed under a very tough scenario, worst case scenario. So, I mean, if the outlook is more positive for the banks, could that lead to more lending to smaller businesses?
Yes, I mean, you've got to hope that's going to be the outcome, but small businesses are still reporting that they're not necessarily getting the credit that they need. But the main problem that small businesses report, and have been reporting for the last 3.5 years, is that they don't have strong enough demand. It's not credit that's their key concern, it's demand.
All right, David Semmens, US economist, Standard Chartered Bank. Thank you.